YieldMax recently changed many of its single stock option income funds from paying monthly distributions to paying weekly distributions. At first glance, this sounds like a positive change because investors receive income more frequently, but in reality, it can cause long-term damage to the fund's net asset value. Every time a distribution is paid, the fund's NAV drops by the same amount on the ex-dividend date. When this happens every week instead of once a month, the downward pressure compounds and erodes capital much faster. YieldMax funds already return a large portion of capital to investors through their payouts. This means part of what is being paid is not profit, but the investor's own principal. By moving to weekly distributions, that return of capital now happens 4 times as often, pulling value out of the fund and leaving less behind to compound. The company itself warns in its filings that repetitive distributions can significantly reduce NAV and trading price over time. The problem is magnified by the way YieldMax generates income. Each fund sells covered call options on a single stock like Tesla, Nvidia, or Coinbase. Selling calls caps upside gains, but still leaves the fund fully exposed to downside risk. When the underlying stock rises, the fund gives up most of that gain to the option buyer. When the stock falls, the fund takes the hit. Frequent payouts remove cash that could otherwise help rebuild NAV after a loss, making recovery slower. There is also an increase in trading friction and operational cost. Paying every week means constant rebalancing, more option trades, more settlements, and more small transactions. All of this adds to fund expenses and eats away at NAV. In calm markets, when option premiums are smaller, the fund may still try to meet its payout schedule, which forces it to return more capital. Over time, that slowly drains the pool of assets that generate income in the first place. The move to weekly distributions also changes investor psychology. Many people see a steady stream of income and assume they are making profit, when in fact part of their own investment is being returned. This illusion of stability can attract yield chasers who focus only on payout percentage and ignore the long-term trend of declining NAV. It is possible for someone to collect huge distributions while the value of their holdings falls steadily year after year. Another issue is sustainability. Option income depends on volatility. When markets are calm, premiums drop. That means less money coming in while the fund still tries to make its weekly payment. The result can be smaller distributions, irregular payments, or more return of capital. Because each week becomes a mini financial test for the fund, the consistency of income is not guaranteed. YieldMax disclosures admit that distributions can vary, may include return of capital, and are never guaranteed. Some investors have already noticed that many YieldMax ETFs trade lower than their initial prices even after collecting large payouts. The yield looks impressive on paper, but total return, which includes NAV change plus income, is often flat or negative. In summary, moving to weekly payouts makes YieldMax ETFs riskier for long-term holders. It speeds up NAV decay, increases costs, and can mislead investors with the illusion of high yield. For short-term traders, it may not matter, but for income investors seeking sustainable growth, it can quietly destroy capital over time. My meter rating is as follows. Income potential 8 out of 10 because the yield is high. Risk 4 out of 10 because of volatility and decay. Sustainability 3 out of 10 due to fast erosion. Flexibility 5 out of 10 because of limited upside. Overall, my meter rating is 5 out of 10. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.